Joining me now is Potomac Wealth Advisors founder and president, Mark Avallone. Mark, good to see you. Thanks very much for being here. Your reaction to what took place yesterday and overall your outlook for tech and AI heading into the new year.
Well, good morning. And yesterday was a very small reminder that market returns are not linear. I noted that 12 of the biggest Wall Street firms are all pointing for 10% gains in that range or higher next year. And I think investors really need to remember those are not linear, day-by-day positive moves. So yesterday was a small blip down, but I would expect more going forward. But on the overall trend, I do agree. And one of the reasons is what you just alluded to, and that is technology. What's happening with technology is enormous. It's not just in AI. It's efficiencies throughout the supply chain. It's efficiencies for end users. It's efficiencies, as we saw in that big defense and aerospace show, and how the military is going to conduct itself going forward. So we believe in technology, tech-enabled companies. Valuations are a little high there, so what we would look for is any pullback to double down on our conviction in technology. But we think that's going to be the driver for a reasonably strong economy in 2025.
Look, we're talking about $6 trillion or something in money market accounts, which is what you're talking about, all this cash on the sidelines. The main event of the week, of course, is the November Consumer Price Index, the CPI coming out, and that could be a market mover. I want to look at yields this morning. The 10-year Treasury yield this morning is trading this way as the market is pricing in an 86% chance that the Federal Reserve cuts interest rates by 25 basis points in the final 2024 policy meeting next week. The yield now at 4.22%. That's up 2.5 basis points. But much is riding on this November CPI number that's coming out this week. Mark, your expectations on inflation and its impact on markets?
Well, I think that investors need to temper their enthusiasm for massive Fed rate cuts. This one in December may be the last one for a while. And I say that because I've continued to say, and it's been an accurate prediction, that wage growth will remain in the 4% range or higher. After this rise in inflation and with the strength that the unions were able to win, the contracts they were able to win, labor has been empowered, and they want and consumers need to overcome those massive inflation hikes we've had in the past 4 years. So wages will be sticky. They don't turn on a dime. Inflation still remains closer to 3 than to 2. GDP is in the mid 3% range, and a 4.2% unemployment is not high. I know it's a percentage point, 0.1 higher than it was last month. That is still not a high unemployment rate. So I think the Fed is going to pause here. They're going to cut here, and then they're going to pause, and investors need to expect a more level interest rate term in 2025.
All right, we'll leave it there, Mark. Great to get your take on all of that. Thank you. Mark Avallone joining us this morning.